Welcome back, everyone. Today is Monday, February 16th, 2026, and the markets are navigating a complex web of AI skepticism, regulatory shifts, and geopolitical maneuvering. We've seen a clear theme today, a rotation away from high-flying tech into more grounded, value-oriented sectors. Before we dive into the why, let's look at where the numbers landed. Wall Street is currently caught in a tug-of-war. While the headline indices like the S&P 500 showed a modest green tick today, don't let that fool you. Underneath the surface, there is significant AI exhaustion. Investors are moving money out of the Magnificent Seven and into the equal-weighted S&P 500. Why? Because valuations for big tech have become stretched to the point of snapping. We saw a rotation today into utilities, financials, and consumer staples. The Fed's hesitation. Markets are bracing for the FOMC minutes and PCE inflation data due later this week. The whisper on the street is that the Fed is in no rush to cut rates, especially with January inflation data coming in higher than forecasted. Alphabet raised $32 billion through a bond sale today, including a rare 100-year note. This shows tech giants are still viewed as the ultimate safe haven for the next century. President Trump has intensified his pressure on the Federal Reserve, expressing frustration with Chair Powell's slow pace of rate cuts. This political friction is keeping the bond market on edge, as the independence of the Fed remains a central talking point for 2026. Now, let's bring it home to India. It's been a volatile session for the Nifty and Sensex. Sentiment remains sideways to weak. The biggest domestic story is the Reserve Bank of India's crackdown on capital market lending, tightening norms for recovery agents. This hit brokerage firms hard. Reduced trading leverage means lower volumes, and the market is pricing that in immediately. The Nifty IT index continues to be the biggest drag, down over 14% month-to-date. IT giants are under immense pressure. There is a growing fear that AI-led startups are structurally disrupting traditional Indian IT services like TCS, Infosys, and HCL. If Nifty 50 slips below 25,200, we could see a slide toward the 25,000 mark. Defensive positioning is becoming key. Keep an eye on the ex-dividend list tomorrow. Heavyweights like HAL and ONGC are set to trade ex-dividend. Globally, the landscape is shifting toward a K-shaped recovery. Some sectors are booming while others are being left behind. British PM Keir Starmer made a historic trip to China, signaling a desire for trade stability amidst US-China tensions. At the Munich Security Conference, Minister Jaishankar reaffirmed India's strategic autonomy regarding Russian oil purchases. He made it clear that Indian oil companies will continue to buy based on cost and risk, crucial for India's inflation management. Bitcoin is struggling to hold the $70,000 psychological level. It's a critical moment for digital assets. News broke about a massive technical error at South Korea's Bithumb exchange, reigniting fears about security mechanisms. We saw $350 million in net inflows for Bitcoin ETFs today, but Ethereum saw outflows. Bitcoin remains the safe bet. The takeaway for today? The market is in a wait-and-watch mode, especially with the RBI's heavy hand on financials. What should you do? Watch the 25,200 level on the Nifty. If that holds, we might see a relief rally. If it breaks, play defense. Thank you for watching. Visit us at our website for deeper insights into managing your multi-generational wealth. Disclaimer: this content is for educational purposes only and does not constitute financial advice.